There are two stocks that really caught my attention this week. One, because of their earnings call, not good, and it's a major player in the industry it's part of. And the other one is in a sector that is, well, let's just say the government doesn't want to see this one fail. The problem is it's failing. We have to talk about what these two stocks mean for the market, what it means for the second quarter of 2023, and what it means for the second half of this year. Stick around, we'll get to that and so much more. Hey everybody, RC Peck here with Fearless Wealth, where I look on a weekly basis what is catching my attention the most. Now here's the thing. You don't want to be reacting to news and information, right? It's very dangerous. It's very scary to be able to retire strong. Now, in order to retire strong, you really want to make sure that your portfolio can take whatever is going on, which means you want to align your portfolio with the market. There are two stocks, and they're both individual stocks, both based in the US, very different, that I want to talk about on this week's call. So let's jump over to them and let's see what comes up while we look at those. Okay, so let's first start here. So the first stock I want to talk about is Tesla. Now this is one of those companies and stocks in many ways that you never really want to bet against. The problem is it's now been in a downtrend for 16 months. Now that's a long time to be in a downtrend, especially considering it's in a longer downtrend than the market itself, right? So if the market was in the exact same type of downtrend, it would be like, okay, everything's in a downtrend in this similar way, but that's not true. Tesla's now starting to weaken as the market, at least over the shorter run, is stabilizing. So you can see here on the screen now from the peak in November of 2021 to where the price closed today. It's after close of market on Friday. Tesla's down about 60%. Now its big drop at the end of 2022, beginning of 2023, that was about 73%. So here's the thing that I really am noticing and why I think it's got some problems. There are people, and I often say to my money management clients, you want to know where the sellers are hiding. And the sellers are hiding right in this area. Now, it used to be back in 2021 that this is where the buyers were hiding. Whenever the price got down to about $200, buyers came in, they loved Tesla at $200. Now, just the opposite. When Tesla is bumping up against kind of this $200 range, plus or minus, people are coming in and saying, you know what, I'm done. You can have my shares. Like they're supplying their shares to the market. And so Tesla's up against a pretty big resistance, and it's in that 16-month downtrend. So look, what was the news that came out this week? They had their earnings calls. Basically, their profit margin went from 30% to 20%. They're cutting costs on the price of their cars faster than their battery efficiency-ness is going up, right? One of the articles I saw this week was Kathy Wood saying, that they're cutting the cost because they don't need to have as high of margin because battery costs are going down. But they're cutting costs. One of their cars, their Y, I forgot the trim on that, but they dropped the price 24% in 4 months. I don't think batteries went down that much. So they're getting really squeezed by all the other car manufacturers out there. So that's concerning from the sense that kind of this, any news is good news, whether it's good news, bad news, or neutral news for Tesla. Now it's kind of turned to, now bad news is actually bad news, and maybe even neutral news is bad news. And that is actually bad news for the overall market because it tells you the sentiment of the overall market. Like, actually, this sounds like bad news, and I'm going to take bad news as bad news. And so that's a sentiment for the market. And so that's going to put kind of more downward pressure on the market than up. It's only one stock, but it tells us the sentiment of the market. Okay, so that's the first stock I want to show you. The second one is a very different industry, and it has to do with banking. This is the 5th largest bank in the US based on deposits. It's one I've never talked about before. So the first thing I just want to show you is the difference between the average bank deposit rate, which is the red line on the screen, right? 50 basis points or 0.5%. And the blue line is 4.6%. That's the average money market fund yield. So that big gap between there is why money is walking out of banks in the US. It's not a bank run, it's a bank walk, right? People are taking their money out of bank deposits and they're going to put them in a money market fund, a CD, a treasury. Now, here's the thing. When banks don't have visibility on how much they have in their deposits, they lend less. They contract in the credit. And that's what's happening, right? They're lending less. And when banks lend less, that's their main job, right? A bank is not a building where that holds money. That's not what a bank does. What a bank does is it takes money in and then it levers up on it and then it lends money out and makes a lot of the economy go. Well, that has basically stopped. And that's not good for the overall economy, which leads to the Fed even saying there may be a mild recession in the second half of 2023. Now, the last time the Fed came out and said there's a mild recession, it was the beginning of 2008, and the mild recession turned out to be something called the global financial crisis. Now, there's a company, Holdco Asset Management. They put out an 85-page deck on U.S. Bank Corp and just slammed it. It's in my email that you guys get from me every Saturday. If you don't have my weekly email, you want to go down into the description and make sure you sign up for that. But Holdco absolutely put out a crazy report on U.S. Bank Corp saying, not good. This bank has not been running itself well, managing itself well. And let me show you what that looks like. I know there's a lot of lines on the screen. It looks like I'm going to say there's 7. Now, these are the 7 biggest banks in the United States. When you look at this, you can see 6 of them are kind of together. Certainly 5 of them are kind of together. The one that's at the very top is JP Morgan, the biggest bank in the US based on deposits. And clearly, since March 9th, which was the day before SVB, Silicon Valley Bank, imploded, JP Morgan's doing great. They're up 8% since the second and third largest bank failure in US history. Then you have those next 4, which are all kind of just plus or minus-ish around 0. And then you got that one at the very bottom, and that's US Bank. It is not looking good. You can tell based on price that the market is saying something is not good with this bank. Remember, this is the 5th largest bank. So yes, the depositors will be bailed out, but not the shareholders and not the bondholders. And that's going to create waves. So here's the actual price chart of US Bank right here, and you can see it, and it doesn't look good. For reference, let me just put a couple lines in here for you. For one, here's the pre-COVID high at about $53. And boy, oh boy, US Bank Corp, they really tried to stay above the $53 a share. Now, this price chart includes dividends reinvested. The story doesn't change if I took those out. This stock, just buyers were coming in at the 52, 53 mark, and then it was just sellers, and then Silicon Valley Bank imploded. You can see that right here. And US Bank never got up off the floor, at least not yet, right? You would want it to see it break above that. So where's some likely, now I don't want to get into prediction of where it's going to go, but places where the price wants to test things out, wants to see if there's buyers, would be the low after the Silicon Valley Bank implosion, right? That's not that much lower, about 3%. But there's a likelihood that it would want to kind of check its COVID low prices, which is about another 22% down. Now, I have talked about Schwab before. Let me just put that in. Put in Schwab there. And you can see Schwab's looking better. It is above its pre-COVID high, not below. US Bank is below. And so because I talked about Schwab in a previous video, you can see even with Schwab down, it's up since then, but Schwab is down 48%. US Bank is looking very different from its really a triple top here. You can maybe even call that a quadruple top. US Bank, as we talk, is down 44% and weakening. Friday alone, it lost about 3.6%. Okay, so let's talk about what to do. Now, the reason I brought up US Bank is because it is one of those banks that is supported by the Fed, the Treasury. Something is wrong with what is going on there. It's not the only one. First Republic, which is a smaller bank that got $30 billion in deposits from other banks, is still not doing well. I go back to the main thing I said before in the early part of the video. Deposits are leaving. That hurts visibility. When banks don't have visibility, they don't lend. When they don't lend, the economy slows down. When the economy slows down, we get something called a recession. It's just this negative loop, which looks like that's happening. Now, people have been calling for a recession for like 2 years. And after the COVID, very quick one, people are like, we're having another one, we're having another one. There's still a lot of money sloshing around, but things are definitely weakening. That's what I wanted to show you, US Bank. And then Tesla, earnings season is going on right now, and Tesla's been in a downtrend for 16 months, way before this earning season, okay? And dropping on the day or the day after they came out with their earnings is not good. Margins going from 30 to 20%, again, not good. So it's an example of what's going on with a lot of companies in the US, that buying is slowing down. They're going to have to cut costs. And it's really talking about just what do you do to make sure that you retire strong. And the thing I'll leave you with just today on this video is something called downside replication. It's what we find in people's portfolios, retirement portfolios. People think they're diversified, but what they actually have is what's called downside replication. And it's one of the things we eliminate. And it's one of the things that make retirements very painful and very anxious. And so we want to make sure we eliminate those. Curious what that is? You want to get a portfolio review? Just go ahead in the description and you can check it out and get on our calendar. I appreciate y'all being in my world. Let me know where you think I got it right, where you think I got it wrong. If there's a topic you think other people are covering that you want me to get my take on, just leave it in the comments. I read them all. And of course, like, subscribe, and forward the video if you found it of value. Thanks so much, and I will talk to you next week. Okay, bye.